All right. Good afternoon, folks. Hope you got some questions for me. Hope you had a good trading day. Um, whatever you got, throw at me. Put it in the chat box, and let's see if we can get some good dialogue going here. Markets faded throughout the course of the entire trading day, basically since the European close. Why did the markets fade? We talked about it in the Phenom Group trading room. We're looking at all facets of the market throughout the trading day. We're looking at breadth. We're looking at intermarket correlations. We're looking at how things are trading overseas up into the European close. We're looking at metals, oil, bond market, obviously, you name it. And what we noticed, obviously, from the opening of the trading session is that small caps lagged, which is not terribly inconsistent with the overall market performance this year. Small caps have, lagged large caps and especially growth. But usually there's some catch up through the course of the trading day, especially if the leaders are growth, if the leaders are large cap. And that didn't happen today. By the European close, we just kept finding lower lows in small caps. And so immediately we go to the advanced decline lines for the NYSE and the NASDAQ and the S&P 500. And we're seeing that while the indices were higher, the advanced decline lines were all down, which, a lot of people don't recognize, or maybe just not hold the experience to understand that most are small caps. So if the Russell 2000 is underperforming, eventually you need to see some bids come in there, or there's not going to be enough flows to go around to sustain large caps throughout the course of the trading day. And at no point did those bids come into small caps. The second thing that we noticed was equal weight was underperforming. Equal weight S&P versus cap weighted S&P. It's just, two big headwinds to hold the gains on the day for the indices. Equal weight lagging and no bids in small caps. Again, eventually these things, start to work themselves out and play catch up with large caps. At least, that's been the trend here this year, and it just never materialized. So, past the European close, you started to see peaking in the indices and then consolidation. And that consolidation just proliferated throughout the rest of the trading day. 1:30 is when Wall Street comes back from lunch, and you tend to get those new orders flowing through the markets. And even with that, not enough. We've got a 2-day event on the horizon. Tomorrow you have Fed Chairman Jerome Powell going to the Hill ahead of to speak to the Senate Banking Committee. And then the following day you have Powell speaking to a House committee. And that the questions are going to center on the economy. They're going to center on inflation and monetary policy. And of course, the politicians are going to do what they do. By the way, what do you think about XYZ policy, or how your policies will impact our policy initiatives? And, for all intents and purposes, Jerome Powell has done a pretty good job, throughout his tenure as a chairman of the board. Sidestepping them, or just flat out saying, by the way, that's not our mandate. You deal with politics, we deal with monetary policy. That's just how it's been played, which is a good thing. You don't want the Fed involved in politics. So it wasn't a risk-off day. I mean, we didn't see and this is a Monday where you typically do have the VIX holding higher levels on the day, because Monday is automatic hedging day for the week. The institutions have automatic programs. It's not like they come in Monday and say, well, I want to. No, it's automatic. It's already done. And so typically you do see the VIX higher through the morning, through the European close, which by and large we did. And then it went negative for a little bit. But it's Monday. Typically, if the markets are starting to fade and roll over, you get that second win. You get those nervous Nelly investors and traders that want to add hedges. And that's not really what we saw today here. I mean, the VIX finished up, uh, forgive me for using cents and dollars, but 12 cents on the VIX, right? So none of this was a risk off day. And it's not like when you look at the defensive areas in the market, healthcare was slightly lower. Utilities were bid, but not gangbusters, less than 0.5%. Consumer staples were up maybe 0.25%. So it wasn't a risk off day. We just had a day that looked like folks just took some time and stayed in cash, didn't add any new positions, so to speak, to any great degree. We had a really nice bounce back in the back half of last week, Thursday and Friday, and ahead of this 2-day Fed event, folks kind of sat on the sidelines. So, all right, questions, get them out there in the chat box, folks. I got about a half hour here today before I have to get ready for divorce care. I do divorce care for my church, so. First question, are only department store type retail stores not working, or are there additional types going bankrupt? Yes. I'd say, and I'm a little facetious here with my response. Yeah, if it's not a hypermarket, it's slowly dying. It's just a matter of when it's dead. You can look at the Dick's Sporting Goods of the world. You could look at the Best Buys of the world. And you can't really even say the world. Like, is there another Dick's Sporting Goods? You could say Academy Sports, but Academy Sports is not, national chain like Dick's Sporting Goods proposes and is still trying to be. So that's a terrible place, Dick's Sporting Goods. I've said for a while, it's kind of, they benefit from the fact that the Sports Authority went out of business. So they got that clientele to kind of, I guess, buy you their longevity as a public company. But that one's just it's a time bomb. It's just a matter of when it goes off. Specialty retailers have been dying, over the last decade, 15 years. Some of the smaller, boutique mall trafficked, Claire's, things like that. Some of the jewelers have, folded up, or they've gotten bought out, became part of roll-ups like Zales and K's, which are the same entity. H. Gregg went out of business last year or 2 years ago. Toys R Us. Those business models those are specialty retail outlets. They're just not long for this world. How many shoe companies have gone out of business, right? Payless and Foot Action of the yesteryears. Remember, Foot Action used to have the basketball court inside of the facility, kind of like Oshman Super Sports used to have the same thing. So they just don't work. They just don't. FEO Schwartz, that toy company. There was a CD shop, back in the day also that went out of business. But yeah, if it's not hypermarkets, these are what they call discretionary destinations. And discretionary destination retail stores, that's just not, there's no reason you have to go there. It's a discretionary trip. I have to go to my hypermarket because they have groceries, or I have to go to my grocery store because I need to eat. So yeah, I mean, they're all dying. It's just a matter of how quickly or how slowly they're dying. And remember, when people throw out the whole retail's not dead thing, okay, I'm not arguing that retail is dead. That's not what I'm saying here. I'm saying you're an investor. All you care about is, are they dying? It's the dying part that hurts investors. Dead, you're done and over with. It's the dying part that hurts investors. Do you think your unbeatable optimism is mostly innate or mostly learned? It's not innate. Yeah, I really don't have to think about that. If you knew my upbringing, my childhood, it's learned. It's learned, and part of that is Christ-based. I don't think it's any secret. I'm a Christ follower. I believe in my spirituality and what have you, and that's been learned over maybe 20 years or so. So no, my optimism. And when it comes to the market, it's about. We talked about this in the Phenom Group weekly market research report that goes out on Sundays. Muscle memory. It's muscle memory. Look, there's a reason why there's perma bears, and they generally just don't do well. They're not on the same side of the market. And don't get me wrong, the market's going to have bad years, but you're never going to develop the muscle memory without remaining optimistic, without remaining in buy mode, without accepting that down is value and it's your opportunity to compound your gains over time. If you're constantly fearful of down, if you're constantly looking for down, looking for problems in the market, doing the whole yeah, but, like that's not a winning strategy long term. That's not going to help your investment. That's not going to help you as an investor over the lifespan of an investing career. You can't develop muscle memory, how to buy, when to buy, and accepting of the value proposition that the market gives you when it's down, unless you're thinking in that more constantly. These folks that kind of latch on to these negative and fearful narratives, that are, well, value, the PE multiple, and higher level of rates and higher for longer narratives, as if they have any substance in how the S&P 500 performs. They're just building their own headwinds to success and financial freedom to a great, at least to their their point of retirement, where they can look at their 401ks, when they can look at their maybe privately managed accounts and say, I did well. Like they're building obstacles. They're building obstacles with the yeah buts, the PEs, the valuation nonsense. These are not winning strategies. Like the Guy Adamis, the Dan Nathans, the Jeremy Granthamas of the world. Nobody's ever accused these people of being world-class investors or traders. Like they're not in that pantheon. The ones who are the ones who just say, I'm getting a cheaper price. These are I mean, what's Warren Buffett, right? I buy a stock, I hope it goes down. As long as the fundamentals don't change, I'm getting even more value. That's optimism. Has anybody ever argued that Warren Buffett is not in that pantheon of greatest investors of all time? Peter Lynch, same thing. I'm okay going down 10, 20%, underperforming the market this year or that year, so long as I'm sticking to my discipline, buying cheaper and holding for longer and benefiting from that compounding opportunity. So not innate, definitely learned, and it's not easy. You don't sound intelligent when you're optimistic, right? That guy's not practicing any risk management. That's not true. That's just not true. The two don't go hand in hand. Optimism and a lack of risk management skills and or discipline do not go hand in hand. We shouldn't assume just because someone is optimistic that they're not thinking broadly and deeply about all facets of the market and economy. Wondering if market will be stuck in trading range for 2023 with bottom occurring in the fall. Don't we all? I think we all have that same question. All we can do is take it, day by day, one step at a time, and read and decipher the market's message as we go. If there were reasons to be optimistic and be of the opinion and flexible to the idea that we won't be in a trading range. Again, I'm not saying we won't be. I'm saying be open-minded to the idea that there's a higher probability we won't be stuck in a trading range. It's because it's year 3 of a presidential election cycle, and year 3 tends to deliver the greatest gains. And again, this is not a matter of astrology. People tie these kinds of statistics like it's tying to, the moon is aligned with Venus. No, these are real facts, folks. The market is it's an extrapolation of human behavior, and human behavior is very repetitive. That's why it's not, when we put out these notions about it being year 3 of a presidential, we've never had a down year on a total return basis. There has not been a down year in year 3 of a presidential election cycle since 1931. That's 20 times. It's 20 and 0. It's 20 to 0, folks. That is a good probability we will be up. Up how much is more to your point. Again, that remains to be seen. Folks talking about, well, it's going to be a year over year decline for earnings. But the early data we're seeing here as the earnings season culminates, basically we're done with earnings season, right? Is that the estimates may have come down too low. I've been saying that most of you who follow me on Twitter have heard me say this now for probably a month, that earnings estimates, the strategists, the analysts may have gotten too pessimistic, and they may have actually come down too far, which would, at current consensus analyst estimates, is basically flat year over year. But the ones that have the microphone, your Mike Wilsons of the world, your Savita Subramanians of the world, they're the ones that have the microphone, right? They have the loudest voice. They're the ones that most people are paying attention to. They're the ones that are calling for a 10%, possibly greater than 10% earnings decline for this calendar year. Right? Mike Wilson just came out with his notes. He does every Monday, saying that, well, and remember, he told you to get off of that tactical trade to the upside in January, right? He made a good call. There should be a tactical rally. He made that call in, let's say, November of last year. Good on him. I give credit where credit is due. But he also told you get out of it, I think, the second week of January. And then what happened? We just kept going until I think the peak was February, the second week of February, and now we've consolidated, and here he is after we rallied again to end last week back above 4,000. He's saying again, tactical rally may be in place, pushing us higher, possibly to 4,200 this time, assuming the dollar and yields don't rise. Right, so they're always, people are. You got to take these strategists with a grain of salt, right? They're just putting forth their best guesstimates. And don't get me wrong, I'm not trying to impugn their intelligence or what have you. They're highly intelligent individuals. But to suggest they're any better than you or I at understanding where the market is going in the interim, come on, that's just a bad practice. It's just a bad practice. Longer term, it's easy, right? We're going higher. It's just a matter of how high and over what period of time. That's how the market works. Lower left-hand corner to upper right-hand corner. But you start narrowing that time frame down to a month and 2 months. It's just a bad idea. You can either look like a hero or a fill in the blank, right? So I've had this belief that we could get to 43.50 this year. If we go higher, good, fine, great. I'm positioned for upside. We should all be positioned for that potential. But at 43.50, I think I would look around and reevaluate. See what the prospects are for 4,400, 4,500, so on and so forth. But over the next couple months, we've got some headwinds. We've got to get past the next CPI, right? We got a CPI reading coming, in a week or so. Got to see, how the market digests that. We're going to start lapping some really big comps from last year because in February is when pretty much all commodities spiked, right? So the comps are going to get easier for CPI, and eventually that summum of it is going to finally make its way into the CPI, and most of you know what that summum of it is. That's shelter and rent, right? Owner's equivalent rent will finally make its way. And I think the tonality around the investment community and the strategist is going to change because that's going to hit CPI like a sledgehammer when it does, right? Because we've been talking about 0.1%, at most 0.5% for one reading in this disinflation cycle. But there's the potential for when that CPI gets hit by shelter owners equivalent rent, you could be talking about a full percentage point. So beware. A lot of what we're dealing with today so far is the hiccup in in some of this inflation data was supposed to be, and you should have anticipated, but B, just fodder for confusing investors, and getting yourselves off sides. Again, manage cash wisely in the interim, small positions until things look like there's more clarity. To the original question, are we going to be stuck in this trading range? That's why the 43.50 target is out there, right? Because that would be above last year's high from August. The Jackson Hole, sledgehammer that Jerome Powell himself brought down on the market. So that's why that 43.50 just picked out of thin air. That's one of the reasons, but it's also in line with my EPS model for the year. So thank you for the question, humble trader ninja. Let's see what else we got. USD outlook. That's not really, that's not necessarily my field of expertise, but what I will say is it's a headwind. I've looked at that 105 level, right? That's been the most recent high. And when we were in the 103s at Phenom Group, we were saying, look, the market's going to be challenged if we start looking like 105 is a near-term probability. And that's exactly what happened. 105 became that near-term probability. We hit 105. Markets consolidated for a couple of weeks. We're just under that 105 now on the dollar in the 104s. But so far as where it's going, the dollar has significant headwinds. You're talking about, it needing to be elevated due to its safe haven status when China was locked down, when it looked like Europe was teetering on the possibility of a recession. Both of those variables now look very favorable for foreign currencies. And you don't necessarily have the reliance on safe haven dollar. So the dollar will be challenged to go higher, but it doesn't mean it can't go higher. I think at most you could get is 107 on the dollar, assuming all things equal, which unfortunately there rarely are. But I think that's a tipping point in the current environment. Fed play a role, especially in a disinflationary cycle. So we have our hiccups in inflation. Again, that's to be expected, but investors know this. That's what the market, prices in advance. It's a forward discounting mechanism. Let's see. What are the two sectors with best returns in next 6 months? Again, I'm not a crystal ball here. If I knew that, Lord knows I would not be behind this computer. I'd be on a beach, sipping margaritas, enjoying life. Or better yet, I'd be, playing the lottery, getting all my winnings, and then making my donations to, the charities that I support while being on a beach, sipping margaritas. But if you want to know where I want to be positioned and where I'm generally positioned, is for growth. I talked about earnings earlier. Think about Amazon, folks. One of the biggest reasons why earnings were so strong coming out of the 2020 pandemic is because of the strength of Amazon's earnings. It's such a huge component within total S&P 500 earnings, right? And that's it's one of the biggest reasons. People say, well, earnings would have been negative last year if it wasn't for the positive earnings out of energy. But they never end the sentence with, and by the way, the fact that Amazon's earnings were down year over year. Because it's something like 22% of S&P 500 total earnings. Now imagine when that switch flips and Amazon grows earnings year over year. People have criticized the analyst community for not taking down earnings fast enough last year. Analysts aren't as stupid as we like to believe they are or propose they are in the financial media or on Twitter. They're not. They know the power of Amazon and its weighting within the total scope of S&P 500 earnings. They also know that whenever Amazon decides to, whenever they decide to cut back spending and promote free cash flow, i.e. earnings to the bottom line, your estimates are going to get blown out of the water so far as full year S&P 500 earnings. So they were very hesitant on bringing down those earnings. And this is, in my career, you rarely see this. I may have only seen this one time in the past where they waited literally to the fourth quarter before they dropped S&P 500 full year earnings like $5-6. I don't remember a time that I saw that outside of a recession because they're not stupid. They don't want to slash estimates with Amazon lingering out there, potentially jumping low bars in the out year. And if you look at consumer discretionary, which is Amazon, they're the most heavily weighted stock in the consumer discretionary ETF next to, I think it's Tesla is number 2, or they sometimes flip flop depending on the price performance. Consumer discretionary last year was down double digits in earnings. This year, they're projected to grow at the fastest pace of any sector. Again, this has been in our weekend research report. We talked to this specifically. We've spoken about this in our state of the markets. We've specifically spoken about the flip-flop that we've seen. Earnings from the energy sector grew something like 30-40% last year. This year, they're expected to decline by around 15-16%. Last year, consumer discretionary declined double digits. This year, they're expected to grow double-digit earnings. So in terms of, if the market is going to be a forward discounting mechanism and earnings are going to grow, if they are going to grow that much in consumer discretionary, which is expected to be the biggest growth category for the S&P 500 earnings, that's where I would want to be buying, right? Consumer discretionary, communication services is another one that is exposed to, and technology. Those 3 are projected to be the biggest year-over-year earnings growth drivers. Of course, if a recession comes or significant event risk happens here and a black swan of sorts, all of that goes out the window. Do you think tech will lead in 20? I don't think tech specifically will. There's industries within tech like semiconductor, software, cybersecurity. I think some of the subsectors may actually be better than the overall tech sector itself. But I'm not willing to go out on a limb and say technology is going to lead. And just to be sure, technology is, you're talking about, so far as the technology sector is concerned, talking about Adobe, you're talking about Visa is even in technology, but Apple and Microsoft. Those are the 2 most in the technology sector, up 30% or so. So you're talking about 2 stocks. How do you feel about the lack of Momo coming off October low and Jan 12 thrust? Good question. Does it handicap the upside for 23, the pre-election year thing? Well, I would suggest that the thrust actually benefit, doesn't restrict, but benefits any potential forward progress. So far as not having Momo, I think it's too early to say that. I mean, we ran for 6 weeks here in the new year before we had the first bout of consolidation. I think what you're probably highlighting more specifically is we got above 4,000 in November, and then we ended the year at like 3,850 or so for round number sake, right? So it doesn't seem like there's been Momo off of that October 13th low. But what I would say is that there's a lot of policy that is still too many investors are uncertain of and not willing to layer in. They're just not willing. And then you have folks questioning the equity risk premium side of things. Are valuations appropriate? So I tend not to, let that play into how I engage the markets. But I think if you're listing pros and cons, the breadth thrust are pros. I mean, definitively. The macro concerns are the cons. But anytime you have breadth thrusts, they generally overpower those macro concerns. So I get your point so far as characterizing Like it hasn't felt like a V-shaped recovery, and that's what it comes down to, right? We tend to define Momo with V-shaped recoveries, i.e., the bottom in 2018, and we just took off in 2019. The bottom in March of 2020, and we just took off and really didn't look back. We had an 8% consolidation in June of 2020, but that was still months after that V shape was already forming. So gold outlook. You're not an investor if you're dealing with gold. That's the bottom line. And I'm not trying to, chide anybody here, but that's not investing. Gold is not investing. Gold is basically, I've got $10,000 that I don't want to see volatility with. And I'm okay with underperforming risk assets. It's just, it's nonsense. Gold is just a dedication to underperforming with that capital. It's not an opinion. The charts are what the charts are. I don't make them, and this is not subjective. Somebody who is investing any amount of capital in gold has to be doing so because it's a risk tolerance issue, and they're okay underperforming risk assets. And I'm not saying there's anything wrong with that. It's just not something I deal with. My stage of life and with family and kids and whatnot, I'm on the Ferris wheel. I'm on the Ferris wheel. I want to keep on this ride for as long as I can because I want to take care of my family in my absence, in my demise. I put any money in gold. I know that amount of money will underperform anything else I do. So stage of life, risk tolerance, they're all things to consider. But for me, I swipe left. I don't deal with it. It's just not for me. Any other questions? I'm going to close up shop. Hope everybody's has a great trading week. I always, I've just started these videos, so forgive me. I wish I knew how to screen. It doesn't seem to be a function for screen share. I don't like Twitter Spaces. It's a funky setup. So I'm doing it here, live YouTube. But I do my pitch as well, and I'm always about investor education. I want investors to be informed. I don't want them to be scared. And most investors, have adopted this opinion of, oh, I don't buy newsletters and I don't buy. Don't. You shouldn't buy newsletters. I don't do newsletters. I do research. That's what we do at Phenom Group. That's how I've outperformed my entire career. It's about education. It's about learning disciplines. It's about learning how to trade. It's about learning how to invest over protracted periods of time. People that think that they can just follow a chart pattern and just follow this guy or that girl. And I watch CNBC or Bloomberg. Folks, that's not investing. That is not education. It's time dedicated to all the disciplines: technical analysis, fundamental analysis, and quantitative analysis. And that's what we do at Phenom Group. If you're interested, you know where to go. So with that, again, I hope everybody has a great trading week. Give me a shout out on Twitter. Share this video. That always helps. And be well. Be safe. Take care.